Welcome to Centennial Advisors. We use our cutting-edge technology and collaborative client-focused brokerage team to provide the highest level of professional service at all stages of our clients' investments. Our team has decades of experience in all types of markets, guiding clients through some of the most challenging times for investors. Our all-hands-on-deck approach generates more offers on your listing, and according to CoStar, we have sold our listings faster and with the highest list-to-close percentages over the past 2 years. For buyers, we identify and negotiate the best terms possible, ensuring your long-term success. We hope your time with us today helps your passive investments become massive investments. Centennial Advisors, here for you now and always.
Good afternoon, everyone. Welcome to our webinar. I'm Justin White. Today I'm joined by Jason Brooks, who is my usual guest as we do these webinars, talking about a lot of things addressing or concerning investment real estate. We've spent a lot of time this year talking about opportunity zones, and that's been a really profitable endeavor from numerous clients. But today, August 25th, 2022, I think we're going to try to talk about all the different things that we're hearing out there in the marketplace. For example, it's 4 o'clock in the afternoon here in California, and the variety of conversations I had today with people that were excited and bullish and looking to do things. And then the other conversations with people that were concerned or cautious about the outlook and what they could do is probably a good indicator of all the different things that we're going to talk about today. We're going to take some headlines from a variety of different news sources with some commercial real estate related articles and chime in with our commentary and opinions, as well as we proceed through the hour-long conversation. If you've got questions about a topic or want to make a comment regarding some of these headlines that we discuss, please use the chat to the right of your screen, and we will definitely incorporate those. Jason, great to have you. Since the last time we did this, which is probably about a month ago, how have you been and what have you been seeing in the market?
Thanks again for having me, and things are good. The market's starting to change. I think it's in certain situations becoming more buyer friendly, and whether it's deal terms, pricing, the only thing that's a little less buyer friendly is interest rates currently, but deals are still getting done and people are still fairly optimistic about deals right now. But I think also people are starting to get optimistic about opportunities coming ahead of us.
All right, well, let's talk a little bit more about that. What we decided to do today was go around to some of the major news sources in commercial real estate and grab some of their headlines and just sort of talk about those and what we see as it relates to those. So our first one's going to be, after slowdown in property sales, repricing becomes the summer's dreaded word. Jason, I'm going to ask you in a second, but U.S. transaction volume fell in the 3 months of the second quarter after the Federal Reserve began raising interest rates. What are your clients saying about what they need to see to get back to maybe the aggressive acquisition stance that we saw in the early part of 2022?
I think the clients that are doing the acquisitions are really looking for some price adjustments, right? Some price adjustments to, identify the fact that the rates have changed, but also that the economy has changed. And it depends on asset class, right? But I think price adjustments and the economy changing are probably going to affect somewhat retail and office more than anything else. I think the apartment space is doing really well still. So, and with big rent bumps coming in places other than LA City, and people taking advantage of it, I think there's some real opportunity out there.
And we're going to talk about that a little later, some of the differences in product types and geography as it impacts where maybe some of the best opportunities will be. But in this article about repricing, brokers say deals are closing are frequently at a discount to the initially anticipated price. The broker featured in the article said price drops between 10 and 15% during the marketing process were the norm. My question for you is not necessarily about pricing correction, but what do you see as the missed opportunity when sellers are locked in on a certain price today?
I think the missed opportunity is, what could that money, even at a lower price, be doing for you somewhere else? And what are the opportunities out there if you trade out? It's not about getting them necessarily the maximum dollar at all times. It's how can you take the money that's there, the locked up equity, for example, right? You have a lot of equity that's, we talk about all the time, your return on your initial equity versus your return on your current equity. And I think being able to utilize that current equity value and what will that generate for you going forward?
It's interesting. People don't look at their real estate, I would say, similar to they look at their stock portfolio. And that if somebody's got a bunch of Tesla stock and they think that Apple stock is going to go up or go up more than their Tesla stock, they don't necessarily concern themselves with what price are they selling the Tesla. They concern themselves more with getting into the Apple stock and being able to enjoy the appreciation and the returns from that at a faster and bigger rate. I think that's kind of the point that you're trying to make as it relates to the real estate, and people looking at it more like that than, well, I wanted to get this price or I could have got that price 6 months ago.
I agree. And I also think, Justin, the pricing reduction issue was 6 months ago. People could throw a price out there that was really aggressive and get over ask offers. I think well-priced buildings that are well thought through are still trading at or close to the asking price. It's just, you can't throw out a wild number and hope someone's going to come in over ask to pay for it.
To that point, and this is kind of market and maximizing price, let's call it tips for everybody out there. Was talking to one of our people in our Burbank office today, and they were talking about some of the deals that they had seen in their market. And there was a building that had been priced very aggressively. And certainly the broker and the seller strategized to price it in a way where everybody was going to look at it, think it was a great deal, want to write offers on it. As of the latest conversation we had, the property had been bid up $700,000 above the asking price because its initial offering price did look so good to the market. So to your point, Jason, there's kind of two ways to go about moving an asset in any market. The one that is not working today is pricing it at yesterday's price and hoping that somebody's going to pay you that, even though interest rates are significantly different, versus pricing it at a number that makes sense, that people like. And then there is competition out there. There are still plenty of people that want to acquire assets, and they will compete for them and pay the top price the market will bear.
And Justin, to that point too, something to think about as the market starts to change is sometimes the best offer is not the one with the highest dollar, right? Sometimes the best offer is the one that gives you the certainty of close. So.
Well, and to that point also, sometimes the most excited person is the first person that comes through the door.
True.
And we see clients sometimes miss that, and it costs themselves some money because they're hopeful that maybe there's more offers behind it. But usually first person in is definitely somebody who's pretty excited about it. You had mentioned it a second ago, Jason, when you talked about some of the markets being different. I'm just going to make a comment, and Jason had talked about, rents increasing in all places, but maybe LA City, and that's more legislatively than market driven. But one of the things that's critical, especially in places that have rent control throughout California, eviction moratoriums in certain places in California, is the ability to mark to market when a tenant moves out of the unit. And probably over the last 3 or 4 months, I would say collectively at Centennial, the things that our clients are finding most surprising is what they can get for a vacancy today. Because of rent restriction, COVID relief, and all these things on the multifamily side that have maybe, tied owners' hands about their income stream with current tenants, is how much the rental markets have gone up during the last couple of years and what you can get when you have a vacancy. For example, just this week, one of our advisors sat down with someone and guided them to asking $2,950 for a 2-bedroom versus asking $2,400, which is what the owner thought they could get. But our advisor had such an extensive amount of information to justify the marketplace and that they could get $2,950 that the owner chose to listen and follow the advice, and they've already filled the unit at the $2,950, which, add an additional $500 or $550 to the NOI. Not a bad thing, especially in today's market with the inability to raise everybody's rents in some cases.
Justin, and from a value and financing perspective, that $500 for 12 months, right, is $6,000 at a 4 cap. That's $150,000 of value in building, and just that $500. And from a finance perspective, if you can get 65% loan to value, you get $100,000 of additional proceeds by that $500 adjustment.
Yeah. So whether somebody's going to be actively bringing a property to market, just kind of managing their income stream, maybe has debt coming due, knowing exactly where the rental market is at today and what somebody can get, I think is a real value that our team at Centennial can bring to owners that are just planning on holding properties right now and kind of taking a wait and see approach. Is that information is really valuable and can go to the bottom line. And we encourage all of you to take advantage of the opportunity to tap into our expertise. Jason, the next article we're going to talk about, and this comes from CBRE and their analytics group, says that to get ready for the highest construction cost increases in years. Now, you do a lot of development stuff. You got a lot of developers in your pipeline. At 14.1% for 2022, this is the biggest increase in construction costs since market data was tracked in 2007. How's that affecting transactions?
It's interesting, right? So anything that's like being sold for people that are RTI, which means entitled, permitted, ready to build, is being affected drastically right now, right? Because the construction costs are so much higher. Construction loans are harder to come by. The rates are higher. People are actually pushing to, on the lender side on construction loans, higher loans to value. So anything that's ready to be built in the next 18 months, the pricing is getting compressed. I would say anything that's a longer build further out, people are still bullish, but that's longer term, more patient capital. Anything that's going to be one of those big longer term developments, they're still doing okay right now. But I think 12 months from now, when people look at hold costs and timing, it'll probably change as well.
So certainly the cost of the goods to build is changing the marketplace. But maybe Jason, talk for a second how the labor costs, and not just the labor of the construction staff, but the labor availability of architects, government, permitting and approvals, and all that process is also extending timelines and delays in construction, which just add additional costs to those developers.
I don't know anybody in the development space that isn't overwhelmed and overworked and behind on schedules. We're hearing from developer clients that civil engineers are 3, 6, 9 months behind on delivering plans because they're too busy. And city staff, right? Like even our expediters that we work with are so backed up because now everybody's like, I need to hire an expediter to push it through faster, that they've gotten to the point that they're incredibly busy as well. So labor on all fronts is really an issue. Obviously, the import-export availability of materials. The one thing to think about is if things slow down economically and there are layoffs in other sectors, that sometimes it does create an additional inflow of labor in the construction field. But also this might slow down some of the construction, which will kind of hopefully balance the supply-demand issue as well.
Question for you: in the supply-constrained markets as it relates to housing, are your for-profit developers starting to see more competition from, let's call it, government-sponsored entities and not-for-profits kind of filling the void to meet the housing demand?
I think that there's an attempt to, but they haven't successfully executed. I think what we're actually seeing is there's been a long time period where people have, buildings that they own with government entities. So like many people don't know, but LA City and LA County own a lot of apartment buildings with private individuals, and there's a lot of restrictions on them. And for a long time, the city has been too busy or not really cared about paying attention to the details and what they're behind. I have a couple clients taking over some of these projects where the developers owe the city a bunch of money. The developers were behind, the owners were behind, and they're taking over these. And so I think there's a lot of focus now on how can the cities and the counties take over some housing supply to help solve the problem. I don't necessarily think that the city or counties are efficient necessarily at operating housing, but they're hoping to, expand their inventory that they control.
I think that's certainly questionable. I saw a Long Beach Post article today about the city getting a grant for $30 million to buy a small 25-room motel and to build 30 micro houses. So a lot of
at $1 million a door, most people should be able to build for that same $1 million 4 to 5 units right now, as long as there's no subterranean parking.
There was a motel included in the purchase as well. Maybe you're down to 500 a unit for your micro housing.
There you go.
Speak to your point a little bit.
There is the state of California did try to build housing at one point, and they used $1 billion, and they got 1,000 units, which is $1 million a door. If anybody's doing the math, so not the most efficient.
We're going to talk about some California legislative changes real quick, some assembly bills and Senate bills. Kind of want to get your comments on those, on how much they're really going to have an impact, and what your clients, are they seeing these things as great legislation that now makes it profitable and feasible to build projects, or if it's really meeting the need and the demand. But Assembly Bill 2097, which would be California's first statewide law to eliminate minimum parking requirements.
Some people think it's helpful. I just think it's hard in parts of California to have housing without parking, right? We've had a lot of clients build under TOC density bonuses and parking limitations, and it gets them a higher density, and it looks great on underwriting, and it looks great on the construction loan. But then people are, wanting to move in, and they say, well, where do I park my car? Right? There's no street parking in a lot of these dense urban areas, or limited street parking, and the private lots are extremely expensive if they're available. So I think there are pros and cons. I think it's a good idea in theory, because if you have to go subterranean, or it's $75,000 a space, and if you have to go above ground podium style parking, you're looking at $35,000 to $50,000 a space. So it saves money, but again, not a lot of people. There's not a huge demand for housing without parking.
I feel like I read a study recently that specifically spoke to Southern California and said the ability to have a car is one of the biggest factors in somebody's ability to, make more money, improve their quality of life, was having a car and being able to utilize it to get around to work or whatever it may be. And so housing that doesn't provide that opportunity may not be matching up with really the needs of a lot of people in the community.
Well, and Southern California isn't one of the dense East Coast cities where there's, great public transportation and everybody's in a small area. I mean, my best friend has never owned a car in his life, but he's spent his entire life between Boston, Massachusetts, and Washington, D.C., right? And there's no need for a car. And yet here in Southern California, we've all owned cars for the most part since we were 16 or 17 years old.
Next one we're going to talk about is Assembly Bill 2011, which is a measure proposed to have a streamlined process for building affordable housing on underused or vacant commercial properties. So let's start. We'll get into the concept or the conversation about reusing some of the commercial space out there, whether it's office or retail. I think my question for you is, are you starting to see some of your developer clients go after the reuse product versus the vacant dirt or already zoned multifamily product to develop housing?
Yes, I think that there's a great opportunity to redevelop properties and reuse them, especially because many properties right now you can most likely buy below today's current replacement cost, so that you can buy it cheaper than what it would cost you to build what currently exists there. So remodeling is faster and more efficient. I think this law sounds really good in theory, but the execution is going to be a lot more difficult. The state has passed a handful of laws recently to try to make development easier, and LA County multiple times and LA City have specifically stated that they will not recognize the laws and they're going to keep their own process, right? Like there was a law about fixing permitting fees from the day you submit your first application, because it was taking 2 or 3 years to go through the process in LA, and the prices were going up a lot on the permit cost. LA's like, no, we're not going to acknowledge that, fixed fee situation. So.
Maybe speak to that a little bit more, because certainly at a state level, there has been a lot of legislation that is designed to facilitate faster housing development and meeting, the needs of the housing crisis. But most municipalities aren't going along or are, dragging their feet. Are there places that are more friendly, or any additional comments kind of on what you see the ultimate outcome of the state on one side, cities on the other?
So I used to think that places like the Inland Empire, so Riverside, San Bernardino County, San Diego County, Ventura County, all the ones surrounding LA, Orange County, we're making it easier. And I think that there still are, they're just naturally easier places to build. Now, I have seen some counties slow down or pause applications for building permits recently for certain periods of time. Now, granted, it might be commercial or industrial versus multifamily, but there is a real thought on slowing down some development as well in certain areas. So, I mean, I think I saw something recently that Riverside is going to pass a law probably by the middle of September that they've never had before, which is going to require a minimum of 10% of every new development project to be below market rate housing, right? So, those changes too start to impact your underwriting when, you're hoping to build to a 4.5 cap, or if you're lucky, a 5 cap. Some people are building to a 4 cap. And, all of a sudden now 10% of your units can't charge market rate rent. That goes to most of your profit.
Which changes the ultimate desire of developers to build the housing necessary to meet the needs of everybody out there. Speaking of development and development constraint, our next article says development bans are spreading across the Inland Empire, where vacancy is below 1%. Now, this refers to industrial, and the city of Norco on Wednesday night debated whether to enact a 45-day moratorium on warehouse development. Now, 45 days doesn't sound like that long, but in such a supply-constrained environment and demand for the space, this certainly, it's industrial, but stifling maybe the economic growth and development of the area in a kind of an anti-development stance. What do you think that the impact this has on, let's call it the industrial market and some of the, that segment?
I think if you own current industrial supply, it probably raises the value of your industrial assets. There's a benefit to the current owners. I think it hurts the overall market and economy in the area. But at the same time, the restrictions that, I don't know if there's a good reason for the restrictions, but if they pass, it's, the 45 days doesn't seem like a lot, but it takes you to the beginning, a little into the beginning of October, which is going to be roughly 30 days from the election. So in the meantime, they can work on some formal law and throw it on the ballot. And then you have, 30-day window to try to get your application in potentially prior to an election and a new law that makes it impossible to go forward and build something.
It's an interesting thing, right? Like a big industrial warehouse creates some jobs, but for as big as the building is, not necessarily a ton of jobs. And there's a lot of concern about the size of the trucks, the volume of the trucks, and then the emissions of the trucks. And This legislation oftentimes seems pretty good for all of those reasons. But certainly from an overall economic impact and providing supply, so there's not a, crisis as it relates to logistics down the road, we're going to continue to need to have more space. And I think to your point, if you own industrial today and near a port, in Southern California, and these areas that have been the hotbed of development to support the the growth of warehousing near the ports, it certainly seems like a ripe time to go, turn your 30,000 feet into 60,000 feet or 120,000 feet. I've had a conversation with a very large industrial owner the other day, and just talking about how all of the metrics have changed so much, and yet it still makes sense to develop industrial, to execute your extension if you've got one, because if you try to go lease somewhere else, you're going to pay way more in lease rate. That just from an acquisition standpoint, is it going to be cheap? No, it's not necessarily going to be cheap that you're going to go buy something today, but 10, 15, 20 years down the road, if it's a 1% vacancy market now, and they're further constraining development, you're going to look back on it and think it might have been pretty cheap.
Right. Well, and they're not the most complex buildings to build either, right? So while there's supply chain shortages and other things, they're not as detailed or intricate as building a multifamily building or, office or retail. So that's also a nice benefit.
We met with a guy yesterday who built 11,000 square feet of plus 20-foot clear height, and he put the first shovel in the ground 6 months ago, and the place is almost done. We had a beautiful building. So yes, to your point that it's easier to get them done and built, and there's not as much to them. Absolutely.
I think there's only one company that's not taking more industrial space in the entire market right now. Now they're a big player and it's a little bit of a different reasoning, but everybody's trying to expand their industrial footprint, every single one.
Well, and they're still going to add 110 million feet. So
that's because they went into contract for it all a long time ago. And I think that they're going to moving into from older product into newer product that's better built for their, I mean, I guess we can talk about it. Amazon's going to go from older product to newer product, not renew their leases in a lot of their older product, but they also committed to an incredible amount of growth in industrial warehouse space over the last 2 years. And so they're slowing that down a bit, but that was part of the demand for 300,000 plus square foot spaces. I also think that they're seeing the ability to repurpose a big box, old Macy's standalone into a, last mile facility versus going into a, brand new building as well. Cause those buildings meet some of their last mile needs too. So.
Yeah. As of today, they've canceled the development of 49 warehouses. In the last few months, it was 16 in June, and now it's up to 49. And so we had seen a lot of interest from the investment community to get a Amazon warehouse, 10-year lease, the whole bit, which obviously Amazon is just a continuing growing business. You can understand why if somebody wants a legacy asset, they're the sort of tenant that you absolutely want. But maybe the demand for those go up now because they're not going to be building as many.
Right. Well, and I think that their credit is they're the ideal credit tenant, right? From looking at it today's day and age. And so, I think the value of the ones that are currently in existence or that they're coming to the market shortly is going to be increased. But I think it'll also be helped the ones that they're canceling on. I know FedEx is looking to expand to, and add an additional 200 plus major similar size warehouses over the next 5 years. So just, because Amazon's slowing down a bit doesn't mean the whole e-commerce and shipping industry. So they'll get filled in, but Amazon seems to be, slowing down, but mostly because they signed a couple 100 million square feet worth of leases over the past 3 years, I think it is. So
yeah, they will still add 110, I think it's million feet, or at least that's what they're committed to.
Right.
Still has plans to add another 110 million square feet.
So let's just say average size 300,000 feet, and they canceled 50, right? So they canceled 15 million. They canceled 10% or 15% of their potential online inventory.
We're going to get to Rocky's question. We've held it for a minute, which is, when is the city of LA going to allow rent increases and evictions? Do you have any ideas?
I don't want to go on record of giving dates anymore because I'm fairly certain I've come on these webinars a handful of times over the past few years since the pandemic started and given my end date guess. The end date guess, Rocky, I can't tell you right now. If you have tenants well below market, I think a cash for keys is a really good opportunity right now, because I think even if you think, Justin gave a great example earlier, 2450 versus 2950, and working with your advisor to get the right number. Well, if you have a client in there, tenant in there at 1600, you think you can go to 2400. In reality, you can go to 2900. I gave you the math on how much more your building's worth off one unit, right? There's a delta in there that you should be willing to pay to get that value up, right? And so I think cash for keys are the best opportunities right now.
I think that opportunity has kind of ebbed and flowed a little bit of when it made sense and when it didn't. And certainly with the rent increases that we've seen recently, getting a cash for keys analysis is something that can really help somebody as they start to target properties and look at whether it makes sense to go in and acquire something today. The rental growth is somewhat has offset some of the interest rate increases we've seen. Rocky, to your question on where are the opportunities for investors with equity, I think that's there's probably more today than there were 6 months or a year ago when everybody wanted to be in the marketplace, and everybody was buying property. The reality is most people that have a significant portion of equity in their property also are not effectively using depreciation. And if they own in Southern California, my bet would be that your return on equity is, after taxes and everything, south of 3%. So when it comes to it from a cash flow standpoint, effectively redeploying the equity can be a really good thing. I think then the second component, and this is where, like, what's the perfect thing? There's probably a lot of things out there. It really kind of depends on what you want your management style to be going forward. And then what is the key objective going forward? Is it cash flow? Is it leaving, yeah, that's what I know. I've been doing this long enough to know that your depreciation on at least most of your stuff was used up. But that's exactly why it probably makes sense looking at it. I mean, I would say that most of the exchange clients we work with are in a similar position where they've been super successful for years. And now they're at a different point in life and there's different options, whether it is cash flow, whether it is, there's lots of different things we can look at. Going back to it, can we improve on a 3% return on your equity? Absolutely. Can you get a property type that better lines up with how active you want to be over the next 10 years? Absolutely. Does it have to be out of state? No. Does it have to be in a different product? No. All those are the variables that we can figure out which one makes sense. But in today's market, I actually think that the people who do have equity are in a better position than they were just a couple of years ago, because there are fewer people in the marketplace that can compete with them. And you have a tendency to get a better deal when there's a little bit less competition because of uncertainty. And, we're going to talk about multifamily here in a minute. And we've talked a little bit about already the rent growth and the strength of that. If you are I only want to own in Southern California, I mean, it makes a lot of sense to own multifamily today because every article we see is about the housing crisis and housing affordability. And whether it's a lack of apartments or it's the fact that people can't afford to buy a house, rents are going to continue to go up. So that might be an option if you want to grow the portfolio for future generations. If you just want to take it easy, there's a bunch of things that we can do for that as well. So if you want to, Rocky, we'd be happy to get together with you. And I think in your case, I can probably walk down the street and knock on the door and we can talk. Or you can come down to my house and we can talk about what your options are and the different things that you guys might want to do. And we can, based on what you want to do, suggest it. But Jason, maybe, for people that aren't in a position where they want to exchange, let's talk a little bit about seller carry really quick, because I want you to weigh in on some of the things that you do when you get engaged in a transaction where the seller wants to carry the paper. And the reason I bring it up is that, there are more opportunities today and we're seeing the volume of seller carry available inventory increase because a lot of these owners that have owned for a long time can actually exit their management responsibility and get a bigger return by carrying the debt than they were making from the operations. And so since that opportunity is available today where it wasn't really available, let's call it 18 months ago, talk about some of the things that you try to get there that sellers need to be aware of to make sure they're well protected in a seller, if they're going to consider seller carry as an option.
Well, and one of the other big things too, Justin, when you do a seller carry is it spreads your gain out over multiple years from a tax perspective, right? Because you're not getting the whole sales price now, you're getting maybe a portion now down and then, a principal and interest payment over a certain amount of time. So things we like to really think about are, the size of the down payment first, right? Because, if you have a loss in equity over, a couple of years because the building goes down in value and you have to take the property back, is there still going to be equity in the property? One of the other things we look at is, the type of, person buying the property. Are they buying it to occupy it themselves? Are they buying it to lease it out? What does the lease plan look like? And then, generally speaking, a guarantee of some sort from the buyer. And what is the strength of the guarantor? How many assets do they have? What does their balance sheet look like? What is their current cash situation? Those kind of things, how much they have in reserves. So, and do we even on like if we're carrying back a loan, do we take an interest rate reserve that we park off to the side to make sure that, if things go poorly, we're able to, take the payments out of there as well.
Hey, Jason, talk for a second, because I think that there's a perception from investors, and there's kind of two sides of it. It's like, oh, I'd never carry back the note because I might get the property back. And then there's a whole segment of the marketplace is like, I'd happily do the loan because if I got the property back, I'm going to get to sell it twice,
Right.
and make more money. So talk about maybe the difference that you see, and just kind of that observation that there are two sides to that market.
Right. So I think if you make a loan, right, and you're making on a commercial property or 80 or 90% loan to value, that's probably where you want to be a little bit concerned, like I said, because if the property goes down a bit, you might be upside down on valuation. But if you say, look, if you're going to go to the market and get a loan, it's going to be 65% loan to value. So I'll take, a 35% down payment. The market needs to drop 35% before you then can sell it and still break even on your loan. I was looking at a housing market article today, and the housing market is arguably in Southern California appreciated anywhere between 40 and 50% over the last 3-ish years. And by some estimations, you're getting well north of 10% compounding, maybe 14, 15% compounding some of the last couple of years. And if there's a housing correction and people are waiting, oh, the market's going to go down. Like, we have very rarely seen the housing market drop more than 30%, right? And so if it drops 30%, you're still paying more than you would have 3 years ago. And so there's a situation, same thing with the commercial real estate. Having a drop of that size is pretty rare. And so as long as you get a pretty secure down payment, I mean, it's not the end of the world to take the property back. To your point, Justin, you take it back, you get to sell it again, and you're going to end up net ahead of where you would have been. Plus you had interest payments at certain points. You were getting the principal probably paid down, right? So your actual basis might be 50% of what you sold it for, and you're getting it back. And if you sell it for, a 20% loss, you still make an additional 30%.
Yeah, there's some different opportunities today. And I think that's what always intrigues me about being in this business, is that over the 20, 25 years I've been doing this, is that the opportunities are always changing, and it's never a static market. It's really, the people that are making profitable decisions are not ever really wait and see. They're just moving with the things that are changing. And so where seller carry almost dried up a few years ago when we were seeing interest rates in the 2s and low 3s, it's different now. Rocky, to your point, how does a seller carry work with a desire to do a 1031 exchange? In most cases, it doesn't. And sometimes people use a combination of both. But what I would say is probably the first thing is to figure out which one's most profitable for you based on what you want to do. And that's something, that I think we at Centennial are able to do a little bit differently from other options out there, is look at all the different things you could do with the property or the portfolio, understand what your goals and objectives are for the next 10 years, and then come up with various scenarios and explain, the pros and cons of each and help come to the decision on what's the best one. And so we can certainly talk about that, and go through some of the different options, because those are two, but there might be a couple others out there. Jason, let's talk a little bit about some of the other changes and things that have been happening in.
I think we might have lost Justin there for a second. Well, if we got a minute, I think one of the things we can talk about too, Rocky, to your question is, there is the 1031 exchange, which allows you to, obviously swap your equity and debt into a different property. The carryback is going to be more of like I don't want to call it a deferred sale, right? But you're going to get a portion now. That portion could be taxable, and then you go with the carryback and everything else. That would pay you, a portion of the principal over time and the interest. Sorry, Justin, I was talking a little bit more about the 1031 exchange versus the carry while we
Oh, well, thank you for filling in. I was going to say, let's talk a little bit about drop and swap, because as we had a call yesterday with a large partnership that had been around a long time, we've seen significant changes in that, in the availability of people to, let's call it, change how they hold title with other people to make it easy for them, or easier for them to go their separate ways. So talk a little bit about some of the key points of our conversation yesterday, for those that are in a partnership, maybe with a partner that they would like to go their separate ways, but thought they were stuck with them till the bitter end.
Right. So historically speaking, when you have, let's just say, an LLC, for example, if you sell as the LLC, historically, you're supposed to buy with the next deal with an LLC in a 1031 exchange. Now, people have been doing over time what's called a drop and swap, where you would exit your LLC entity, for example, into a tenants in common ownership interest. That tenants in common ownership interest will be the same proportions that you hold, your LLC ownership interest in. So let's just say Justin and I own a deal together. Justin owns 60, I own 40% of that deal in an LLC. We drop and swap. We drop out of the LLC into a tenants in common, Justin owning 60, myself owning 40. And then when we go to sell, I can go 1031 exchange my own way in my own direction to my own property, and Justin can do the same. Now, there were two theories of thought over time. One was you need to season the deal, which means that you have to drop and swap. You have to drop out first of the LLC and then season it in the tenants in common. Some would say 1 tax period, and some would say 2 tax periods as tenants in common before you could sell. And then there was the other group of belief that said form over function, where you could do it right before the sale of the property, and it doesn't matter because 1031 exchange is really about, is the taxpayer before and after when you sell the property and then buy the next one, is the taxpayer the same? And there was a couple court cases recently where the second opinion, where you can do it at any time prior to the sale, you don't need to season it, have won. So the IRS challenged someone doing it in the form over function, and the person that did it won. So now you can drop and swap up to a day or two before the close of your sale and not be in violation of IRS rules and go your own direction.
And Jason, just to kind of add on that, in the example you used, we were going to go our separate directions in a 1031. We don't both have to go into a 1031. If you wanted to stay in, I can cash out, I can do a DST, I can do whatever I want with my money, and you can do whatever you want with your money.
You could pay your taxes. You could just take your basis and invest your gain into an opportunity zone. There's each individual member is welcome to do whatever makes them happy. So,
great. I'm glad we covered that, because over the course of my years, I've heard a lot of people feel like they were stuck with somebody who's become the wrong partner. And certainly those recent cases create a lot of opportunity for people to be able to happily go their separate directions. Next thing we want to cover, and somewhat to Rocky's point when he was talking about what are the opportunities for people with equity, is that over the last few months, I think we've seen a lot of what we'll call legacy 1031 exchanges. I know you have a number of large family clients that you work with, but where second or third generation owners trade the assets built or acquired by their family members 50 or 70 years ago. And instead of the labor-intensive capital expense of a remodel and an upgrade, they are exchanging assets into newer buildings that may be multiple properties, so that different sets of family can go their separate directions and kind of start building their own empire with what the family had acquired before. Talk a little bit about that. Talk about some of the nuances and the mechanics, maybe for either parents that have built up these portfolios that have a lot of kids and grandkids, or those kids and grandkids that are now taking on these properties that are older and not a lot's been done. And somebody's going to have to spend a lot of time overseeing the expense of a lot of money to get buildings, up to as nice of a condition as they could go out and buy today.
Yeah, this is something that's come up a lot, actually. Even before our webinar today, was talking with another client who is a longtime family friend of all people, my grandparents. So they're relatively up there, in age in certain ways, and they inherited a couple of apartment buildings in Southern California from their parents, right? And so now, you have a brother and sister owning it. So we'll use them as a perfect example. It's a 50s property, 50s era built property. They've owned it since the 60s or early 70s. One is in Anaheim and one is on is it like Overland, I think, between like Pico and Olympic, something like that. And they've owned them forever, and they're starting to have tenant issues. The buildings are older. They've done enough to maintain the property, but it could really use like a nice revitalization. And you have a brother and sister. Brother lives in California, sister lives in New York City, and they own it 50-50 now. And what we've talked about is, look, you're getting to the point of retiring. Do you really want to be, you've been plenty successful on your own. This is kind of nice to have, and you make cash flow off of it. But do you want to be dealing with tenant issues, repair issues, maintenance issues? Are you maximizing it? And then the next step is, well, none of your kids work in this business, and none of your kids want to be managing it. They all have careers and jobs. And also, like, do the kids of the brother and sister, the cousins, all get along? Not necessarily. So by 1031 exchanging out of this property, they're each able to go and buy their own separate, lower maintenance, lower headache, lower hassle properties that are then not only good for them in the upcoming years of their life, but really great assets for their children to inherit, because their children, again, aren't going to be in the situation with all having professional careers of wanting to deal with property management and headaches. So I think there's a huge advantage right now from an estate planning side, from where is my life now based on different than 20 years ago, and what do I want for my life for the remainder? And then, does this in any way benefit my family in the future?
What are some of the buildings that you've seen people acquire, or give us what they had and then what you've seen them acquire that are starting to do some of this stuff?
So a lot of strip centers and apartment buildings, right? So small to mid-sized apartment buildings, even some larger ones, 50, 60 units. And then strip centers, strip malls, those kind of, situations where, there's smaller retail centers. So those have been a lot of what seemingly is being sold right now. And I will say, a lot of people, the convenience of the triple net properties, we've talked a lot about triple net properties. They're the least management intensive. So we are seeing a lot of triple net property purchases, but also if you can 1031 exchange and sell 15 units here in Southern California, and you can buy 45 or 50 quality units somewhere else, a 50 unit building can support management expenses better than, a 10 or 15 unit building. And so some people are like, I still like apartments. I still like the upside. As you said, Justin, massive housing shortage. And so I still want to be in the apartment space, but with a larger building, I can afford to, hire a management company so they deal with the problem.
Excellent. We've only got 12 minutes, so I'm going to move us on to a totally different topic. We're going to talk about offices and occupancy in office. Our next headline is: a group of Apple workers is reported to be petitioning against the iPhone maker's deadline, calling for employees to start working in its Cupertino and other Santa Clara Valley offices for at least 3 days a week starting September 5th. My question for you is twofold. One is, how long do you think this is going to last, this face-off between employees and employers on going back to the office? And then number two, you obviously deal with a lot of contracts, leases, lease negotiation for large corporations. What are you seeing on the front lines in the, releasing of space, or, when leases are coming due? Are companies taking the same size space? Are they downsizing? Are they totally going, what percentage of space are they re-upping? Those sort of things.
So that's a really interesting question. I think that the standoff, let's talk about the standoff first, and then we'll see what in the leasing market. The standoff is right now so heavy in the favor of the employees because the employment market is so strong that employees are able to demand many things that they want. I think if there's an economic slowdown, and as we're starting to see some companies lay people off, it will be a Darwinian proposition where kind of like, the strong will rise to the top. The people that come in are more likely to stay and less likely to get fired. If there's going to be layoffs, they're probably going to look at those kind of things. And that will be something that probably drives people back to the office. I also think in certain situations, if your office offers a lot of really good employee benefits, the tech sector being one where there's free dry cleaning and 3 meals a day and all these other benefits on the campus, those places could have a bigger return faster because people want all those additional employment benefits. But again, at the start of the pandemic, 2 weeks into March, Google announced it was closing its Austin campus for the year and just told everybody to work from home. And there was just a substantial savings by not offering 3 meals a day and dry cleaning and massage and all the exercise stuff that they would get. So if the benefits come back, then I think you'll see people come back as well, along with the economy. On the leasing front, I think companies that are growing and expanding and were aggressive in taking new space over the last 12 months got some pretty solid deals. I can tell you our law firm renewed, extended, got new leases on 9 of our, just happened to be the window they all came due, but 9 of our 12 offices. And we were able to get really fantastic deals, and we're taking more space because we're growing. And so we were able to get really, really beneficial leases in those situations. Now, I think as the office market becomes more distressed, you're going to see a mix of leasing where if somebody buys a distressed office building at a really low price, they can offer potentially below market rent, but because they bought the building so inexpensively, it actually financially benefits them just to fill the space quickly. So it'll be an interesting time and an interesting thing to think about, but we are seeing, a lot of Class A office debt is coming due. It's all CMBS over the next year, and the rates are going to be drastically different. So it's going to be an interesting time, but there are a lot of distressed players that are long-term, very positive on the office market.
So when do you think is the peak of the debt coming due / lease expiration distress in the office market?
I'd say sometime in the next 12 months. I can tell you, I saw an article the other day that over the next 8.5 months, there's about $9 billion worth of CMBS debt coming due on Class A office in Manhattan alone. That's a big office driver there. So I think you're going to see over the next year, it just happens to be a lot of CMBS debt coming due. And a lot of that debt was 10-year debt put on at, as the economy started to recover after the last down cycle. And for those of you that don't know a lot about CMBS debt, there tends to be a very, it's a big penalty if you prepay, right? Like it's just a very difficult debt to get out of. They generally have yield maintenance where you have to pay the whole amount of the insurance or the interest. And so it's, oftentimes costs inefficient, but now the rates have changed so drastically, people are going to struggle to see the rates they were seeing then.
Thank you, sir. I love making you make predictions. It's fun to keep track of how you do.
Win some, lose some.
From the good news department,
yeah,
you just said that in Southern California, housing has probably increased in value by 50%. Did you say over the last 5 years? Was that your thing?
I think it was about between 3.5 and 4. If you looked at 10 to 14% compounding over the last 3 to 4 years, it's been pretty good.
Okay. I'm going to top that phenomenal statistic with that the housing affordability index fell to 98.5 in June, which is the lowest level in over 33 years. Why is this the good news department? Because if you can't afford housing and there's a housing crisis, people got to live somewhere.
You have to rent. If
So
you increase the supply of renters and you're not increasing the supply of affordable rental units, your demand goes up drastically, which means your pricing increases.
So I know some of you hate what's happening in California as it relates to landlord unfriendly legislation. And I know some of you on the call are hoping and hoping and hoping the prices are going to fall 40% because interest rates went up a little bit. The reality is that for those that are willing to deal with the challenges, Southern California apartments are still going to be a really good thing to be buying, and there's a great opportunity to get good quality assets today. So my take, and Jason, you work with a lot of large multifamily buyers, is that the appetite, the fundamentals support still a very healthy appetite and a very good long-term outlook. Yes, people are probably looking for deals, but the strength of the income stream may not support a significant price change.
My 2 or 3 biggest apartment clients in Southern California have bought a substantial amount of deals over the last 4 months because they see the opportunity. They see, but they're also smart, right, Justin? Like, they do the math the way I did the math earlier on the $500 rental increase, and they're not afraid to do a cash for keys. They're not afraid to pay a tenant, $15,000 or $20,000 to leave when they know that in doing so, it creates $150,000 of value. Because if I walked in today and said, Justin, hand me 20 grand, I'm going to hand you 150, you'd probably say yes every time.
So we got 4 minutes left. We're going to jump into, I think, our favorite topic of 2022, opportunity zones. The headline is investments in federal opportunity zones appear to be accelerating 5 years after the tax credit program was launched. My first question for you as we wrap this up today, Jason, is why do you think that is?
I think that a lot of people made a lot of gains in the stock market over the last 3, 4, 5 years. I think a lot of people have seen a lot of uncertainty in the stock market. And I think a lot of people then sold stock and have capital gains, and they have money to invest. I also will tell you something. I think it's probably the best real estate investment, maybe the best investment in general out there right now, in my personal opinion. And I think it's a great opportunity for people to look and take advantage of. And so I think those two things combined. Also, a lot of people made huge profits on their houses in the last 4 or 5 years in the sales. And all of a sudden they're exiting those houses and have these huge gains and don't really want to pay all those taxes. So they can take their gains from the sale of their houses and do this as well.
The slide up on the screen is a highlight of some of the opportunity zone transactions that we've done. When Jason talks about the financial benefits provided by the opportunity zone legislation, there's some pretty significant numbers up here. Millions of dollars either deferred in taxes or millions of dollars in future gains avoided by utilizing opportunity zones. Jason, I'm going to read you another line from one of these articles. Governors in Montana, Alaska, and Georgia, and the mayor of D.C., for example, picked areas with the lowest levels of pre-existing investment. Meanwhile, governors in Hawaii, Vermont, Nebraska, and West Virginia chose places with the highest levels of pre-existing investment. This relates to the places that are designated opportunity zones. How has this haphazard designation process created opportunities for your clients?
I think, and I'm going to give a lot of credit to the advisors over at Centennial that have been working with them as well. They've identified the, let's call them census tracts or areas in which the governors elected somewhere that necessarily shouldn't have been elected in order to, drive more investment there. But they're great areas. I mean, Justin and I were talking today about, a development across the street from the, mall in Woodland Hills that's being remodeled, and it's got really high-end, couture fashion stores in it. We've talked about locations in certain states where, even in, if you like Los Angeles, like mid-city Los Angeles area, there's so many great locations, and it's just about working with your advisor to find the ones that are really good and shouldn't have been placed into opportunity zones, right? There's a bunch that shouldn't be there. And you find those ones. I mean, we've talked, Justin, to a client of ours collectively that bought some properties, including a property for a residential home development in an opportunity zone in the nicest golf community on the island of Kauai. Like, it doesn't make any sense. There's $5, $6, $7, $8, $9 million homes in there, and this person's gonna be able to go in and build a house and rent it out and treat it as a rental and sell it for a big gain someday and not pay taxes on it. It's just about identifying those properties, and I think working with your advisor to do so is really important.
I said it a second ago that I think the most fascinating thing about the investment real estate business is that opportunities are always changing. And this is one of those things that specifically as opportunity zones, the window of opportunity to get into the really good opportunity zones, maybe the misclassified opportunity zones, is closing. They're going to make those changes here by the end of the year or early next year that are going to take some of the best ones out. But if you get into them before they get taken out, you're still going to get all the benefits. But I think that, that's a lot of what today was about, was talking about a lot of the things that we're seeing that are changing in the market, that are creating new opportunities for people. For those of you that joined us, if you saw the back and forth with Rocky and his questions about his situation, is he's got opportunities today that maybe they didn't have, or they didn't have them as good or as great 6 or 8 months ago as they do today. And so exploring those options, seeing what's out there versus just sitting on the sidelines and taking a wait and see approach is a really profitable decision. You can see our opportunity zone clients in the millions of dollars of gain and benefit and tax avoidance that they've experienced by getting involved in some of these transactions. And you can see whether it's brand new construction car washes or Chipotle's or 7-Elevens, or as Jason said, a brand new multifamily development in Southern California. There's phenomenal opportunities out there for people looking and trying to figure out what are the best things to do. We hope that you enjoy the webinar. You get a lot of valuable information, and if whether it's Jason's team at Buchalter or all the advisors here at Centennial can help you figure out what's the best thing to do in the rest of 2022. We look forward to the opportunity, and we thank you for attending. Have a great evening.